Hello and welcome to Thank God It's Friday. We have a host of events lined up for the next few weeks, starting with the most important union budget, followed by the next RBI monetary policy meet and the state elections, and of course the ongoing earnings season. To discuss all of this, I'm being joined by Gautam Chhaochharia, the ED and Head of India Research at UBS Securities. Thank you very much for joining us, Gautam. The benchmark Nifty 50 index has risen about 600 odd points since the demonetization lows, recovering almost all of its losses. What has really driven this sharp rally, and does that mean that the markets are factoring in like a zero impact or hit from demonetization, which is not the case? So is it some over optimism that's playing out?
So I'll say three factors. Firstly, what's happening globally always matters.
Right.
So including what's happened to emerging markets post-Trump, markets have done well. Within India, two clear factors. One is demonetization itself. So I think there is a lot of worry in November, December that this demonetization is going to be a big deal breaker for India.
Right.
And because of so much pessimism in parts of the market and a lot of anxiety amongst global investors, once we started seeing data points suggesting that the impact is there, but marginal or at least improving in some cases, it's kind of a respite. A lot of investors had panicked, little bit of selling also we saw, shorting happening. So we are seeing that covering up happening as we speak. And lastly, the big thing about India over last few months and definitely last 2 months is local flows. So the money coming into local mutual funds continues to be strong, and that's also helping markets do well.
All right. So not many are expecting any big bang sort of reforms from the 2017-18 union budget. So populist budget or fiscal prudence, what is it more likely to be in your view? And in each of these cases, how would that impact markets?
So our view is, base case is government will still stick to a fiscally responsible roadmap rather than going whole hog into populism. One, because if you go into populism so early, elections in 19 is still 2 years away. So you run the risk of 2 years when the cost of populist also comes back into inflation, etc. Secondly, if you want to go extra populist now, in a way you end up also acknowledging that demonetization has hurt.
Okay.
And thirdly, the data points also coming out, at least as we speak now, does not seem to suggest that the government needs to panic about demonetization and therefore come with a populist or a stimulus package. So our base case is still going to be fiscal consolidation. Now whether it's from 3.5 to 3 or 3.2, 3.4, again those are things we'll talk and debate about, but that doesn't really matter, and I don't think will matter to the markets also so much. For the markets, the big picture is whether we consolidate fiscally or we expand fiscally. So whether fiscal deficit remains at 3.5 or 3, I don't think will be a big deal for the markets. If it goes to 4%, then obviously it matters.
Which is looking unlikely for now. Okay, your thoughts on the third quarter earnings so far and the key takeaways from all the management comments. Does it look like there has been an element of overestimation of the hit from demonetization? At
this stage looks like, clearly, because the headline numbers definitely have been very relief, if to use a word. And again, there are two parts here. One is you're looking at the big listed corporates when you're talking about results. They were anyway part of the formal economy. So their impact from lack of cash or liquidity crunch is relatively lesser versus a small business. And secondly, they have their own long supply chains, etc. And people have tried innovative techniques also to take care of their various requirements post demonetization. So the impact to be felt also, if any, could be slightly later. So yes, versus really negative expectations, this has been a respite, a positive surprise at the margin. But the big picture for us has always been that the immediate impact is the demand impact because of liquidity crunch. The real impact for us to worry or not worry will be seen only after 3 to 4 months. Because what you should think about is not near-term liquidity crunch led demand impact, but is it actually leading to business models being destroyed? Is it actually leading to job losses which are permanent? Because then the impact will be beyond 3-4 months. That will only emerge later this year. Our base case is it will be irrelevant or very insignificant.
That was exactly what I wanted to ask you in my next question. I was going to ask you how you're looking at the fourth quarter earnings now, and if you're expecting that demand destruction to probably extend beyond March, but you'll wait for more data points before you.
So I'm not saying that demand destruction will extend beyond the 3Q or beyond March. I'm saying that if at all,
it does.
The real impact of demonetization will be seen then, not now, because now it's only liquidity crunch impact, supply chains are long. So real impact will be seen then. Our base case is the impact will be very, very marginal and unlikely to last beyond initial 3 to 6 months, because very simplistically, all of us are ingenious. We find a way to get back to business, and that's what's happening.
Okay. Do you think any reduction in the income tax rate will be able to negate this impact of the demonetization hit?
At the margin, yes, but not absolutely, obviously, because again, it's impacting a lot more the informal sector who may not have been paying taxes. But yes, if it shows up in tax cuts for the people who are paying taxes, their ability to spend and consume goes up, definitely. So at the margin, yes, and that's the other point when you talk about prolonged impact not being there, because if the government and policy makers start seeing any prolonged impact, it's very likely they intervene with some policy response. And therefore, it's a kind of a counter argument that to expect that this will be a prolonged impact, you're presuming no policy intervention by the government.
Okay. Is the 25 basis points cut in the repo rate a given on February 8th? Or, and if it is so, do you really think it will bring back the credit demand, which is of course at a multi-year low right now? Will it bring that back anytime soon?
So again, the linkage is there between lower rates and credit cycle, but not necessarily always completely. So when you talk about rate cuts, we still expect 50 basis point rate cuts this year. So the rate cut cycle should continue, but a lot of that may be already factored into some market interest rates, when looking at 10-year, etc. Whether it itself leads to credit cycle, it plays a small role definitely. Credit cycle has many other factors: the real credit demand, the investment cycle, capex cycle, etc. And the way we look at interest rates role in credit cycle, or even from a macro stimulus perspective. So the rate part is two parts. One is the nominal interest rates, and second is real interest rates.
Right.
So what we have seen till now over the last couple of years, RBI has cut rates in line with falling inflation. We still haven't seen real rates being cut meaningfully or at all.
Right.
And when you talk about stimulus or itself driving credit cycle, this real rate matters a lot, because for the corporates, if the WPI you look at 3% odd, you still have very high real rates. And just to keep in perspective, the last time there was a big stimulus in 9 and 10, real rates were negative for both WPI and CPI basis. And that was a big stimulus too for consumers as well as manufacturers.
Okay.
Not the case now.
Okay, so moving on to the assembly polls in Punjab, UP, Goa, Uttarakhand and Manipur that will begin on February 4th. Do you expect the outcomes to probably have a greater bearing on the markets than the budget itself?
Look, our usual view on state elections are that they don't matter for markets. There's a lot of noise and commentary. People obsess about it. There's always assembly elections every year. And why we say it does not matter, because we have seen it very rarely, if at all, impacts policy making by the central government. Okay. So the broader policy direction, whether we want fiscal stimulus or spending in specific areas, does not get altered by state elections. National elections do play a role, state elections no. But in this case, because of demonetization, there's a lot of discussion, debate about whether Mr. Modi's popularity is intact.
True.
And in that context, UP elections does matter more than what we normally would say for other state elections, simply as a barometer of Mr. Modi's popularity. Now, the tricky question here is how do you measure that? And frankly, no one knows the answer. It will be very qualitative. But the markets would be looking at UP election results more as a barometer of Mr. Modi's popularity than they would normally other elections.
All right. Now, FIs were net buyers of Indian equities in the last week. So, do you think this is some sort of a trend reversal, given that the dollar has also come off from its highs, or just probably some aberration?
So, I won't say it's also in line with what's happening for broader emerging market flows. It's not India specific per se. Now, India also was a big overweight market for many foreign investors, so that also plays a role. But it's been happening across emerging markets. So emerging market flow outflows have continued.
All right. I just wanted to understand what are the themes, according to you, that look promising right now, and your pecking order, of course, in terms of the sectoral allocation.
So the big theme, as we discussed in the beginning, is whether we change policy direction or not. So what we have looked at India macro top down is we have seen two distinct phases of policy cycle. We had 9, 10, 11 of expansionary policy, both fiscal and monetary, and that led to very, very high growth rates for GDP, earnings, everything, and markets also rewarded that growth period. And then you had the impact of that in terms of inflation, currency, and then last 3 years has been all about consolidation, fiscal, monetary, balance sheets. Okay. So, and that's the reason behind our cautious call over last 2 years, that we've always been advising caution that don't get carried away by expectations of growth recovery in India. It will take time. So the big theme to watch out in this year, specifically given the backdrop of demonetization, etc., is whether there is a reversal or early signs of reversal of policy stance of the government and RBI. And that's where the budget also comes in.
Right.
If it's status quo, it's status quo, then our thesis remains that growth will keep on being sluggish for a while.
Okay. Sectoral preferences as of now?
So keeping that in mind, the first point I'd like to make is that unlike historically, we're focusing a lot more on stock picks than sectoral calls, because we have been seeing over the last few months, given the various moving parts, the dispersion within sectors has gone up a lot. But having said that, the big two sectoral overweight calls we have made recently over the last couple of months, which we want to highlight, is one, we went overweight IT services. We have been underweight for last 2.5 years, because we were worried about the structural concerns they had. But in our view, the structural concerns are now priced in, while the cyclical upside in terms of demand is not priced in. So we like IT services here. Secondly, in terms of the consumer staples. So we upgrade consumer staples to also overweight, because if you look at demonetization and the policy moves around that, it looks like the government's intention seems to be to somehow transfer income and wealth to lower income population.
Okay.
Which if it plays out and they are successful, then obviously staples should be the biggest beneficiaries, specifically after last 3 years of really tough environment. The underweight call for us, the big one, is still industrials and infrastructure. Okay. So we don't see any signs of capex cycle picking up. And public or government capex, I think markets talk about it a lot, but that's actually insignificant in the scheme of things. It doesn't move the needle. Okay. It moves the needle for micro segments like say highways, but not for the broad capex cycle.
True. You were talking about IT and how a lot of the issues are already are being priced in. Are you sort of settling down with the fact that we may not see the kind of growth rates coming for these IT companies that we had seen in the past? So with the price and the backdrop of the price corrections, you're okay with that?
So that's been our call for last 2.5 years. So our negative stance for last 2.5 years was based on this, that growth rates are going to be structurally lower, because the Indian IT companies are incumbents when the world is moving towards digital. Right. And they will be the one who will be disrupted. Right. Unlike in the 90s when they were the disruptors. Right. Okay. But in our view, the stocks have derated sharply over last year, and the stocks are pricing in this lower growth outlook. On the other hand, we see an outlook of improved cyclical headwinds, which means next year or two, the revenues can actually do well. So you will have a short-term 1 to 2 year period of growth actually picking up, but the longer-term trajectory will still be muted.
Okay, and just one last question. I wanted to understand if you think there's going to be any further delay in that bad loan cycle peaking out, because of course there could be some risk from especially this SME and the agri segments, and with that, what's your take on the banking and financial services companies?
So we don't worry about it too much. That risk is there, and that risk is, or that view is premised on the broader demonetization call. So again, in our view, demonetization is likely to be a short-term liquidity crunch impact. Any impact beyond that is too early to take a call on, and that again presumes no policy intervention. So if it's a short-term impact from demonetization, then NPLs should not be impacted much from that.
Even if we talk about the sub-segments, of course, and I'm talking about NBFCs because that was actually the hot sector pre-November 8th. Talking about, say, gold financing companies, you have microfinance, you have housing finance companies, anything that has really, where reasonable valuations have become reasonable now, according to you?
So again, at stock levels, yes. Sector-wise, not really. Because Indian markets are still not attractively valued. Risk reward is actually very unattractive. and valuations appear to be attractive compared to 6 months past peaks,
Yes.
not in absolute terms. But what we have seen across sectors, we are seeing relative mispricing. Like if you look at NBFCs, without naming stocks, I can't talk about individual stocks.
Right.
But within NBFCs, we saw in January, as to one stock was kind of pricing in as if demonetization is a big negative impact, and
Yeah.
another stock was pricing in as if demonetization never happened.
Right.
So those kind of opportunities we have been seeing over last month or so. Absolute terms, I don't think we are yet at absolutely attractive valuations.
Okay.
But the basic approach towards NBFCs for us has not changed. So we still overweight NBFCs.
All right. Thank you so much for your time
Pleasure.
once again,
Thank
Gautam.
you.
That's all for today's edition. Thank you so much for watching Bloomberg.
Thank you.